Welcome to the source of commercial real estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with Milo Spector with Northmark. Milo is a senior vice president at Northmark. He's been involved in the industry since 2014 and has been 100% focused on net leased assets throughout his career. Milo specializes in national leased investment sales of single and multi-tenant assets with significant track record in both the education and restaurant sectors of the net leased investment space. His skill sets include sale leaseback, portfolios, JV equity partnerships, build to suit, standard acquisitions and dispositions, forward commitments, and 1031 exchanges. Milo, along with his partner, Chris Lamuto, most notably assisted the co-founder of Gateway Academy Schools with the disposition of a 21-unit portfolio encumbered by CMBS debt. Before Northmark, Milo served as senior director at Stan Johnson Company. I'm looking forward to talking to Milo about some of those education assets that he's gotten so good at brokering. Milo, how are you doing today?
Doing great. Appreciate you having me on. Happy to discuss, a little bit of early education investments.
Great. Milo, why don't we get started by you telling us a little bit more about your background, how you got started in real estate, and what your work looks like today?
Yeah, for sure. Some of those things on there I didn't realize would be coming up, but just to kind of touch on it, nowadays I'm really focusing on the early education space. Our team has done transactions across 95 centers across the U.S. So we're pretty well versed in it. Northmark as a whole has done a whole lot as well. We account for about 50% of the sales at Northmark of early education assets. So, working with a lot of companies directly, working with developers, doing rollouts and things of that nature to help operators grow, working with 1031 buyers and institutional folks to kind of, get those things sold. So that's kind of where I'm at in terms of, what we've been doing. I've been doing this for, I don't know, going on 10 plus years now. And, really just kind of going forward with this education thing.
So let's define our terms then. We're talking about early education assets. This is probably an asset class that some people are not familiar with. So when we're talking about early education, what are we talking about?
Yeah, for sure. So a lot of folks will call it childcare or daycare. A lot of these centers are more than that. They offer preschool and things like that, education. Some of them even go up to high school, depending on the brand. But they are an essential need for the U.S. and other countries in terms of being able to let people work. And we really saw that through the pandemic, right? So it really kind of highlighted how really, really important they were. So early education is just is a term that we use in the industry to just define kind of like that preschool and younger age group education services.
I have a 4-year-old, and so I am going through all these tours of these exact early education properties. And so I am learning kind of the whole continuum of what these tenants could potentially offer to families. So Milo, why don't we start out with you giving us an overview of, you touched on the pandemic, and I know this childcare issue really became front and center during the pandemic. So give us kind of a 30,000 foot view. Where are we in the child education asset space right now? And you can even frame it in terms of the pandemic. What were we experienced before the pandemic? What did the pandemic teach us, and where are we at now?
Yeah, I would say that, like every other retailer, there was a period of time where everyone was scrambling to kind of figure things out. Luckily for a lot of operators in the early education space, they were allowed to kind of keep some of their centers open, not all of them. Some of them did keep all of them open during the time period, but it it really was centers that were near hospitals and first responder kind of folks and essential needs kind of folks that were able to utilize services, because obviously if you're a nurse at a hospital or whatnot, you need someone watching your kids in order to be able to do in order to be able to do your job. So it kind of hit a lot of operators pretty hard for a period of time there, but now everything's good. Most of the large operators are, at where they were at prior in 2019 in terms of enrollments and financials. And, some of them are even exceeding those levels. So that, is a really good thing. And I think we've kind of recovered from that.
Has there been an increased spotlight on this asset class? I feel like over the last couple years, there's been an increased interest in this asset class because of the realization that people have gone through of, realizing how essential these tenants are. Have you seen an increased interest in this asset class?
Yeah, definitely. I would say, 4 years ago, 4 years ago, um, things were a lot different. Folks weren't really looking at it as hard. In 22, we saw a really big comeback. A lot of folks were, really hunting for assets, and all the core retail stuff, the drugstores and the, Dollar Generals, discount stores, that kind of stuff, QSR. A lot of them were getting competed on, and they were, folks weren't really able to lock them in. So there was a lot of people kind of looking at other different things than they usually would. And I think that really helped kind of increase the demand for these assets. In a lot of cases, you can get, a higher cap rate on them than just retail in general, probably like 50 or more basis points of spread. In 22, we saw the cap rates really go down just because the demand was so high for net leased assets. But in general, you see kind of this spread between retail as a whole, single tenant retail, and early education. So, it's definitely picked up. I think people are realizing that there's a lot of good operators out there, and a lot of folks, signing long-term leases. A lot of the time, absolute triple net leases, and sometimes corporate, depending on the operator and things like that. So. It's definitely picked up. I think also you can't do this stuff online. They try to do that. There are companies that offer those services, and, you can kind of get away with it to some degree, but in terms of like development of the brain and social skills and all that kind of stuff, you really need human interaction, which I think the pandemic really forced everyone to realize. So, pandemic was rocky, but I think that came back a lot stronger.
Milo, let's talk about the nuances of what people need to know when considering this asset class. So, will you talk about kind of the nuances of valuing early childhood properties? Are the tenants largely mom and pop tenants, kind of solopreneurs? Are these largely institutionalized assets with corporate guarantees? What should we know when considering whether or not this is a good investment for us?
Sure. So, it's a mixed bag, right? There's some very large operators, the top 50 operators. We have some really big players in the space like Kindercare and Learning Care Group. And, I think what you want to look at is like any other net lease asset, kind of what's the credit behind the lease. If you can't get the financials, then what's the unit count and kind of what are you getting in terms of backing? Looking at the lease terms, like any other net lease asset, how long that is, whether it's absolute triple net or if there are some landlord responsibilities, rental increase structures, things of that nature. And of course, the bare basics, location, and trying to figure out whether, demographics are good and things like that. A lot of these centers will be in affluent areas, although there are some brands that specialize in, more subsidy and lower income. So you just want to make sure that the brand that you're looking at is a good fit for that community. Occasionally we get enrollment data, and sometimes we get, financials. So if we do get those things, obviously those are good things to review, but they're not always available. And sometimes you just got to kind of look at it and understand whether it makes sense to you through your underwriting. I will say that, a lot of the early education assets are owned by institutional groups. So if that means anything to anyone, to me it does, because they have pretty strict underwriting, especially like publicly traded REITs and things of that nature. So, if it passes the sniff test for them, I feel like it should for, maybe a high net worth individual looking to plug some money in.
What sort of expectations should investors have in terms of lease? Are these typically triple net long-term leases? Are they short-term leases? What should someone expect?
It's pretty similar to any of the other net leased retail. I'd say most of the leases that we see out there, if it's new construction or a sale lease back, those would be, 15 to 20 years. Occasionally we see 10, but really 15 is kind of the benchmark. In terms of rental increases, we kind of see like 10% over 5 years, 2% annually, occasionally, maybe a 7.5% every 5 or 1.5 annually. A lot of them are absolute triple net, but we do see some operators will sign things where there's a couple of landlord responsibilities, but nothing substantial, kind of your typical double net, so to speak, roof and structure kind of stuff. But yeah, I mean, pretty strong leases for the most part, and very similar to what folks are seeing across the board.
In terms of the tenant and the guarantor, if someone is looking at Crexy or getting emails with some of these tenants, what are some tenant names that should pique someone's interest in terms of a strong guarantor, without, you're certainly not putting your reputation on the line, but some of the major players for people that are unfamiliar with the asset class that would get someone's attention?
Yeah, for sure. So like kind of like blue chip tenants, so to speak.
Exactly.
Yeah, I would say like Kindercare is one of the top tenants out there that folks look for. They have a ton of centers across the U.S. And they're one of the largest operators. Learning Care Group as well, fully corporate leases, and ton of locations across the U.S. We are working with a new group, well, not new, but new to the U.S., called Busy Bees. And they have about 119 locations in the US, but over 900 globally, but corporate leases on that. Bright Horizons, we don't see them a whole bunch, but they're the only publicly traded early education operator, and they do a lot of business to business type, programs where they, if some company like, let's just say Intel or something like that, needs to provide childcare for their employees, they'll either set up shop inside of their headquarters or provide paid for early education service to a center nearby. So yeah, I mean, I would say that those are kind of the blue chip. There's a bunch more on there, but those are kind of the blue chip when folks think about it. I would also say that there's nothing wrong with the mids or the growing operators. You just kind of got to understand the story. There's a lot of brands out there that people don't know and that may be very strong, and you just kind of got to dig into it and understand what you're getting.
Milo, I live in a state where there is what they call universal pre-K,
Mm-hmm.
where it's a state funded stipend for
Mm-hmm.
all 4-year-olds, and they provide a certain amount of money. And as long as the childcare provider, meets certain standards, they're able to receive the stipend directly from the state
Mm-hmm.
for my child to go to this daycare. I'm wondering, I, as a commercial real estate investor, I think about the trickle down impacts of maybe somebody who would, without the stipend, not send their kid for
Mm-hmm.
affordability reasons, not send their kid to pre-K as a 4-year-old, but now the state is funding it. So maybe now they can't afford to send the kid 2 or 3 days a week. That's going to help these pre-K operators. I'm wondering if you pay attention to any of this, and if so, if you're seeing any impact on these sorts of state programs impacting these tenants and properties.
Yeah, for sure. I mean, I am aware of them. I don't really, get too involved on the operations side since I'm really just working on the real estate side. But, from what I understand, I think they're largely a good thing. I think a lot of operators look at it that way. I don't think it really, it depends on how much subsidy is in a center, right? And which brands, but a lot of brands don't want to have higher than a certain amount of subsidy. So, it kind of varies from state to state as to what that program looks like, right? So there's no real catch-all necessarily, but in terms of an investment for someone that's looking to just collect cash flow, I don't think it really makes a huge difference in, whether they're going to have a tenant or not.
Yeah, just thinking, in preparing for this interview, I think I saw Vermont and Oklahoma are states that offer universal pre-K. I'm in Colorado, and the stipend is fairly new, so I'm just thinking how it could trickle down if if payment is coming from the government. That's a pretty solid funding source. So
Yeah.
yeah, interesting to get your perspective on that. Um, if an investor is considering this asset class, what sorts of due diligence items should an investor be looking into? We talked a little bit about it before, but I'm thinking about financials, enrollment numbers, obviously real estate fundamentals, location, demographics. What should an investor be thinking about when considering this asset class?
Yeah, I mean, look, at the end of the day, whatever you can get in terms of financials, sometimes that's, a lot, sometimes that's not a lot. So it just kind of depends. If you can get those, great. If you can't, then again, you just kind of want to look at the unit counts and kind of understand how the school is doing and how it's positioned, kind of fundamentals, things like that. I think enrollment, especially for a new school, there's a ramp up phase, right? That can take, anywhere from I'd say 1 to 3 years before a school's profitable. So I wouldn't harp on that too much if you're, looking at one of these assets and they're not necessarily fully enrolled or something along those lines. At the end of the day, you just want to make sure you're going to get your rent and that the school is, doing well. And if there's a good story there or some backing as to, how the school's ramping up, enrollment trends, things like that, if you can get, then you can definitely kind of look at that. In terms of other due diligence, typical stuff, environmental, which on that front, we're not seeing a lot of centers being built on former gas sites or anything like that. So that's nice. Property condition report, those kinds of basic things.
How would you advise an investor looking for value add opportunities? I imagine there's the typical cap rate play of expiring leases and that kind of thing. Are there other opportunities for value add investors to potentially capitalize on some upside on one of these assets?
Yeah, I mean, I would say that there is definitely, as you mentioned, doing kind of that blend and extend scenario where if a school is doing well and you have a few years left on the lease, maybe going to the tenant and seeing if there's and maybe the option to extend the lease and get a little bit more term on there, which would increase your value. I mean, the rule of thumb is that once you hit 10 years, once you get past 10 years, it's kind of, the properties start depreciating. And that's really the same across the board in terms of all net lease assets. So, that's one play. I would say an interesting play that I don't think a lot of people think about are new companies or relatively new companies that are in growth mode, where the guarantee may not be substantial yet, but there may be a strong story or strategy in place. And those assets tend to trade a little bit higher in cap rate because there's a little bit more risk. But in the long run, if you feel strong that the company is going to do well and you like everything that's going on with it, they potentially could go down in cap rates, which would increase the value of your property. So that's kind of an interesting play. If you're able to get a center that's in a good location that is vacant for whatever reason and retenanting it. That's a whole other thing as well. But kind of the typical things that you would think of.
Do you see much demand for vacant properties in terms of retenanting them? Are investors willing to take risks in terms of buying a vacant property and leasing it up? Is there much demand in that space?
I mean, it takes a certain type of investor to do that, right? So largely we see developers doing that kind of stuff, right? It's not really like it's some high net worth folks that are looking to deal with retenanting and all of that kind of stuff. But in terms of demand from other tenants, yes, there's plenty of demand. If you have a decent center that's pretty cookie cutter in a good location, you shouldn't have a hard time releasing it. I think that's a big misunderstanding or misconception about the industry is like they are somewhat specialized buildings. And I get this a lot, right? I get this whole thing of what do you do with this building, right? It's a small office or whatnot. Realistically, we've seen some of the, dialysis centers and urgent care kind of stuff happening in terms of transition. But what you really want is another early education operator, right? Like it's the same thing as a fast food restaurant. And there's a lot of operators out there. I don't think folks really know that, right? So there's a lot of operators out there that are looking to grow and have private equity behind them and stuff like that and need to grow. So during the pandemic, it was funny, right? I got everyone was nervous about their tenant leaving, but I got nonstop calls from operators that just wanted me to see if there's a way that the current operator would break their lease. We actually had one deal that went together that a developer did that they said that they were out, and we had someone immediately get back in and cancel the lease early, right? And it was a new long-term lease with higher rent and just an all-around better situation for the person that bought the property. So it's it's why try to reinvent the wheel when you have something strong,
Milo, I'm wondering, in this scenario, an investor is considering an asset like this. Are there any metrics available or an investor should be considering in terms of analyzing the demand in a market? Like so many so many seats of pre-K per thousand people in the town. Is there any way to gauge demand, supply and demand, to gauge whether this market needs more childcare, this market is oversaturated, or is it pretty much every market needs more childcare?
It depends, right? There are some markets that need it more than others. There are markets that are more saturated. I would say this though, it's kind of one of those things where, if you see another childcare center in the area, or if you see a few different, early ed centers in the area, it's probably a good sign. It's kind of that whole thing, right? When I used to do a lot of QSR, people would see a McDonald's next to a KFC or whatever, right? And they would, or let's say Burger King, since they both sell burgers, right? And they would say like, oh, okay, well, there's competition right there. Well, yeah, but you also have some of the best real estate minds in the industry that decided that that was a good site. So it may be a good thing if you see more operators in a certain area, especially if they're, high end brands and things like that. In terms of demographics, I mean, look, if you think about it logically, right, you want families, you want young folks, you want increasing communities, you want things like schools surrounding so that people have an easy way to drop off their kids all in one place and then shoot over to work. Those kinds of things. 0 to 6 population, that's something that you can look into if you really want to get nitty gritty. But in reality, just, I would look for good population counts. I would look for good income to make sure people can actually afford, the early education and childcare services. And you should be good to go.
I would imagine with this asset class in particular, investing in a growing population would be especially important.
Yeah, definitely. And there's, you're in Colorado, there's a lot that has there's a lot of issues with trying to get childcare and early education centers going out there. Not that they don't get up and running, they're just a little bit more complex to get licensing and things like that. So, it's a higher barrier of entry market. And we've seen a lot more pop up, but that's kind of one of those things that is kind of interesting to me, right? Kind of creates, as you mentioned, right? Like if there's a need, there's a little bit more of a need out there, I think, in some communities.
Well, you bring up an interesting point then. So, if there are certain states or regions that have a higher barrier to entry, I would imagine cap rates would be lower and returns would be lower. So, that makes me wonder, are there states or regions in the country where maybe it's easier to get licensed and so it's a lower barrier to entry and so maybe there could be uh, more opportunities?
Yeah, I mean, I think that, you know, I think that the the markets like Colorado again is a pretty good one. Theoretically, yeah, you would have lower cap rates on that, lower return on something like that. In a lot of cases, folks don't even know if it's a higher barrier to entry kind of deal because the developers dealing with that or the operators dealing with that. So it's a little bit more behind the scenes, a little bit harder to understand if that's a factor. But a good broker will throw that in the package if they know. And there are certain states that would be a little bit easier to get centers going. I think, I don't know for sure, but I believe the Southeast in general is pretty easy. Some states to get things done, kind of just like development in general, right? Like some certain states are California, New York, et cetera, are much harder to get things put in place and take longer, right? So, but yeah, I mean, the nice thing about something like that is that you do have some intrinsic value there. And I believe, don't quote me on this, but I believe that that stays with it. So if something did, happen, God forbid, you would be able to get someone in there and there's some value there already.
Sure. Finally, as we get towards the tail end of our conversation, are there any headwinds that we should be aware of in this asset class, be it the debt market or struggles with licensing or operators having difficulties? Anything investors should be aware of when looking at these deals?
Yeah, I mean, I would say on debt, there are a couple of things on debt that you should be aware of. In a lot of cases, you're not going to be seeing, um, you know, uh, um, non-recourse debt. You're going to see more of the recourse debt, which I think there's a lot more of that going on, probably loosening up a little bit now. But there was a lot more of that kind of going on, and you're looking at much lower LTV in a lot of cases than historically kind of what you would see. So more of the 50 to 65%, but I'd say 50 to 60% LTV. You're not putting like you're not getting like 90%. Although there are a lot of folks out there that can do different things. I think let some life companies may be willing to do some sort of modified non-recourse and things like that. But I would say that in general, I would suggest using a loan broker to find you the best banks, someone that has worked in the space, because I can't tell you how many deals I've seen where someone has some relationship with the bank that did their house, and then they try to do the deal and they swear up and down that they can get the loan, and then all of that to come to a head after we're under contract or whatnot, and the person having the bank say, well, why aren't you just buying like a McDonald's or something? Because they want to just have an easier deal to get done. So, I would probably, I would leave it to the professionals, even if it costs you a little bit of money to have them go out and find the best banks for you. But that's my suggestion.
And finally, Milo, I want to open it up to you. Is there anything you want to leave listeners with in terms of something we haven't talked about or the trajectory of this asset class?
Yeah, I mean, I think that like you said, I think there's a lot more demand these days. I think that folks are starting to kind of understand the tenants and different things like that. I think there's going to be a lot more activity in this space in years to come. And I'd be happy to connect with folks that are looking to, try and invest in the space or learn more about it. We have a nice team over here that could help you out. I think you'll probably add my email or something like that, or some contact info. But yeah, I would love to discuss more with anyone that has interest in the space.
Sure. And if people want to connect with you and learn more about you or talk more about the early education asset class, where would you like to send people?
Yeah, I mean, you can either find me on LinkedIn. That's a pretty easy one. My email address is mspector@northmark.com. I think you can probably put that on the bottom or something like that, but probably my email is the best way to do it.
Perfect. Milo, sincerely appreciate your generosity of expertise and time with me today. Thank you so much.
Absolutely. Thank you very much for having me on the show.
Listeners, thank you so much for listening. If you enjoyed this conversation, feel free to reach out to either one of us. We love talking about commercial real estate, and we would love to talk to and connect with you. Thank you so much for listening. Until next time, take care.
Thank you.